Welcome back. You're still in the snapshot version for transaction cycles, and this time we're going to dedicate this snapshot to acquisition and payment cycle as well as the inventory and warehousing cycle. So, a while back in the previous snapshot, we did present this interconnected diagram of the different transaction cycles, and we were able to talk about the revenue and receipt cycle. So, now the spotlight and the focus will be on acquisition and payment. Based on the Philippine CPA licensure examinations, acquisition and payment is being referred to as purchase to pay. So where revenue and receipt was called order to cash, this one is called purchase to pay. And again, is made up of two very distinct functions. Number one relating, of course, to purchase, and the other one relating to disbursement. That is why in some literature for auditing theory, you'll be able to find that this is referred to as the purchasing and disbursement cycle. So, of course, in the area of purchase or in the business function of purchase, we refer to goods and services being acquired from vendors and employees in exchange for obligations to pay. In the disbursement side of this cycle will, of course, be that obligations from vendors and employees are paid. Now, you may notice that we have been referring to employees even in this cycle. This is because some companies do not have a distinct payroll and personnel cycle. This might happen whenever, for example, companies only have a few employees, say one or two, not really that labor intensive. And so, if there are only a few employees, they might sense that payroll and personnel is not so pronounced and they may want to include it in acquisition and payment instead. Okay, but generally, for most commercial establishments, they do have a separate payroll and personnel cycle. So let's go back to this one. Whenever we talk about acquisition and payment cycle, it is actually the mirror or the opposite of the revenue and receipt cycle. Now, if you recalled the once upon a time, the trigger document for the revenue and receipt cycle was actually was actually the customer order. So here, it will be triggered by a purchase requisition. Now, a purchase requisition is being initiated by the user department and approved as well by the supervisor or the direct manager of that user department. Because at the end of the day, it will actually be the user department who can evaluate if they really need the goods that have been requested. So the purchase requisition comes from the user department and is approved by the direct supervisor, manager, or head of the user department. Now, we also have to make mention that not all businesses have a formal requisition process. Some businesses make do with a phone call where they will simply call in their requests. Some businesses have a more formal document in the case of a purchase requisition. Regardless, the once upon a time of this cycle starts with a purchase request. Now, once the request has been deemed appropriate, then what will come out next will be the purchase order. So the purchase order is the more formal document now and has to be pre-numbered and authorized. This kind of like serves as a formal document of the commitment to purchase from a vendor. Now, once that we have placed our order with the vendor, then the vendor will of course ship this out to us because we are now the buyer. And once received, then the receiving department will, of course, prepare what we know to be the receiving report. Now, the receiving report will, of course, be compared to the purchase order to make sure that what was received was actually ordered. Now, some businesses have an added control of removing the quantities. I'm so sorry, that should be shows blank quantities. Some businesses have an added control of removing the quantities from the purchase order that is being sent in the receiving department. This is being done in order to assure that the receiving clerk will actually count the goods which are received and would not simply tick off the box, right? So this is again to ensure that there was an actual counting made, but as what we have mentioned, this is normally an added control in the receiving department. Now, once a receiving report has been accomplished or has been prepared, we now wait for the arrival of the vendor's invoice. And when the vendor's invoice would arrive, this is where we do the three-way matching. This will be matched with the RR or the receiving report and the PO or the purchase order before requesting for payment. Now, in the previous cycle, the revenue and receipt cycle, we said most of the business's customers have more than one transaction during the month, and so therefore we send out monthly statements to the customers. This time we are on the other side, we are on the receiving end, and so our vendors will also send us a monthly statement. We now call it the vendor's monthly statement. So the three-way matching that we did, the vendor's invoice, the receiving report, and the purchase order, this will comprise what we call the voucher package. And the voucher package will be prepared by the accounts payable department for approval by Treasury and recording, there it is again, recording by General Accounting. Okay, so this is essentially the storyline of what happens in the acquisition and payment cycle. But because this is where the purchase of merchandise also comes in, then we do have to deal with the entire purchases family, including purchase returns and allowances as well. So, similar to what we discussed a while back, where we said the shipping document and the sales invoice are important in that they represent the actual sale and the recording of the sale. In this case, the receiving report represents the actual purchase because the goods have been received, definitely title has transferred, and the vendor's invoice become the basis for the recording. So we do pay particular attention to these two documents. A while back, we also said that in the case of the revenue and receipt cycle, there is a presumptive significant risk over overstatement of revenues and receivables. However, in the case of liabilities and expenses, the auditor is on the lookout for possible understatement of liabilities and expenses. Because of this, the auditor performs testing for cutoff and a search for unrecorded liabilities. Now, the testing for cutoff or in the search for unrecorded liabilities is a test for understatements. Have you noticed? Right? It's a test for understatements, thereby, it is a test for completeness. So, the main assertion being tested for cutoff testing and unrecorded liabilities is the assertion of completeness. Of course, included to that will be the assertion of cutoff. So, we normally do this one, or the auditors normally test for unrecorded liabilities. One such possible way will be to perform what we call testing for subsequent payments. So, say for example, the year ends December 31, the auditor would normally test payments in the subsequent year, say the first 3 weeks or even a couple of months into the next year, because, well, if it has been paid, then most definitely there's a related liability to that. So, the auditor will then trace or determine if that payment is for a liability that should have been recorded in the year under audit. So these are just some ways for the auditor to search for unrecorded liabilities. Now, for some businesses, the purchase of property, plant, and equipment will also come into play here in this cycle. In the case of property, plant, and equipment, the auditor is actually on the lookout for possible unrecorded retirements, knowing that if a business fails to de-recognize items of PPE, meaning to say the item is no longer there, it has been disposed, it has been sold, but then the accountant forgot to remove it from the books of accounts, then this will definitely mean that the asset accounts will be overstated. And because the asset is still there, even if it's no longer there, but it is still there in the record, then it will still be depreciated because the basis for the depreciation will be whatever is in the record. And so, therefore, assets are overstated, net income will be understated because depreciation is overstated. So the auditor has to be on the lookout for possible unrecorded retirements. And how would you know that there are unrecorded retirements? Well, there may be some telltale signs, such as, for example, if there are new acquisitions. Because if there is a new acquisition, then that most likely means that there have been assets that have been disposed. Like what we always say, kung may bago, siguro may pinalitan. So new acquisitions may actually be replacements of disposed assets. So you check if these disposed assets have been properly de-recognized. Also, be on the lookout for miscellaneous income accounts, as these miscellaneous income accounts might refer to proceeds of disposals of assets which have not been correctly recorded. So maybe the company received cash as proceeds, and so they are sure to debit cash, but they don't know what to credit. They don't know how to de-recognize the assets, and so they said, okay, let's just put it under miscellaneous income. Okay, so be on the lookout for miscellaneous income or sundry income accounts. And be on the lookout as well for discontinued insurance policies. Maybe the insurance policies have been discontinued because the asset is no longer there. Or if you notice, for example, changes in the arrangement or the assembly line, maybe they have transitioned from manual to digital. Or another might be you might search or you may randomly select from the PPE master file and then locate the asset itself to determine if it is still there. These and many more are just some of the procedures of the auditor to test for unrecorded retirements. And of course, we all know how to compute for depreciation, right? For as long as it's straight line method. Just kidding. Of course, we do need to determine the reasonableness of the client's depreciation computations and the amounts charged to depreciation, as well as the testing for valuation. This is where our consideration for asset impairment and revaluation would also come in. And as with all transaction cycles, we do have to consider management assertions, audit objectives, and the control activities related to this. Hopefully, all of these things will help you imagine better whenever you encounter multiple choice questions relating to acquisition and payment cycle. So, there we have it. We're done with sales and collection. We're done with acquisition and payment. Let us now move on to inventory and warehousing. Now, we know that this is a very unique cycle in the sense that it does not have a direct interaction with cash. Rather, it is concerned with the physical flow of the goods as well as the costing. Whenever we see the line item inventory, we know it is made up of both quantity times the cost. So it is concerned with the physical flow of the goods as well as the costing. Now we're gonna delve a little bit into cost accounting here where we talk about prime costs. Prime costs, of course, would refer to direct materials and direct labor. And we know that prime cost would involve the purchase of raw materials, which will be tested in acquisition and payment, as well as the payment of payroll, because this is where your direct labor would come in, and this will be tested in the payroll cycle. Conversion cost, on the other hand, which will involve, of course, overhead, which is indirect material and indirect labor. Indirect material will be tested in the acquisition and payment cycle. Indirect labor will, of course, be tested in the payroll cycle. Then we will have inventory storage in the case of finished goods inventory, and this is where our inventory tests would come in. And this is what is unique to the inventory and warehousing cycle. Because when you now talk about the shipment of the sales will again be tested in the sales and collection cycle. So in terms of testing inventory of in terms of the unique tests to be performed under inventory and warehousing, we will encounter here the presence of perpetual inventory records. If your client is maintaining a perpetual inventory system, then the presence of a well-maintained perpetual inventory record will be an added bonus or an added plus to the controls of the client. Of course, we know that clients are not required to use the perpetual inventory system. We know that. But in case they are, then a well-maintained perpetual inventory record is a plus. Okay? It could spell out a strength in internal controls. Another thing that we'll be encountering in this cycle, unique to this cycle, is of course the presence of the client's cost accounting system and their cost accounting records. Now, we know that the cost accounting system of a client is unique from one client to another. We can't have a one size fits all, as our clients' operations also differ as much as their products differ. Okay, but the cost accounting records will also be part of what we will audit in this cycle. It is also in this cycle where we get to talk about the observation of inventory counts. Now, please take note that what we said is observation of inventory counts because the main responsibility for the actual counting of the inventory would actually be with our client. because the client, regardless of whether they utilize or they maintain perpetual or periodic inventory systems, are required by the accounting standards to conduct an inventory count at least once a year. So, therefore, the auditor will observe the conduct of this inventory count. And when the auditor observes the conduct of this inventory count, the auditor is actually testing for not just the existence of the inventory, but also the condition of the inventory, thereby giving the auditor an idea as to whether there are obsolete inventories or slow moving inventories, physical characteristics such as the presence of cobwebs or inventories that appear damaged or non moving. These are all things we get to observe in observing the client's physical inventory count. We acknowledge that inventory is one of the largest accounts for most commercial establishments. They are diverse. Like, if you get to imagine how many types of inventories we have, at the minimum, raw materials, work in process, finished goods, we still have supplies, spare parts, and the like. So, they are diverse items and often found in multiple locations, which could sometimes pose a challenge to the auditor, especially when the auditor decides to conduct surprise counts of inventory. And of course, valuation challenges. Do you remember first in, first out, or weighted average, for example, or even periodic and perpetual inventory systems? And of course, who could ever forget that inventory has to be valued at lower of cost or net realizable value? So all of these things add up to the challenge of auditing the inventory and warehousing cycle. So, again, we recall every time we encounter a multiple choice question for this cycle, we always go back to the management assertions and objectives of the auditor, and of course, the control activities relating to PIPs, including segregation of duties. So that's about it for the the acquisition and payment cycle, as well as the inventory and warehousing cycle. We're going to make a quick pit stop here because in the next snapshot, we're finally going to talk about the remaining two cycles, payroll and personnel, as well as capital acquisition and repayment. So I hope you join me in the next snapshot to complete all five cycles.